guys, Trader CJ. Welcome to today's video. It's going to be about dollar cost averaging, also called DCA. So it's basically a term that's originated from investing. So when people want to buy, or traders want to buy, for example, Tesla shares, they want to buy every single month on a regular term, like a buying for their retirement. So they want to buy 100 shares every single month. So when the market is going up and down during that month, or sometimes you're going to buy at a higher price, sometimes you're going to buy at a lower price. So, but it averages out the buying price, original buying price for all those shares that you bought. So, for example, when you're retired, you're going to end up with like 20,000 shares or 200,000 shares, and you have an average price where you bought those shares. So, but the problem comes in with, I won't say it's a problem, but it gets riskier because people apply those same principles to intraday trading, and most people do it in prop firms. So some prop firms allow it, some don't. So this is very risky. So disclaimer in everything, read that. So you can see, look at this equity curve. So this thing is buying the dips. So every time there's a bit of a pullback, it buys, take a small profit, and it averages in to get a better price. So, but it's not taking losses, and it's carrying positions overnight. You can see like a nice uptrend, just taking profits. Some strategies or some algos have the same equity curve, and people sell it for like a monthly subscription, or like try to people to get this specific strategy to trade it. But when you look into like the smaller detail, you can see there it's actually extremely risky. So looking at the performance summary, for example, on this specific thing, you will see that the drawdown is like 16,000. So that's like you need to stomach a 16,000 to actually just make 16,000. So you're basically risking your whole account. So, but when you put in, so let's change the parameters or the settings in the strategy. For example, you need to exit at the end of the day. Okay, so let's make that exit at close, make it true. Let's see the effect on this specific strategy. So like I said, futures and CFDs, it's geared, it's leverage. So that's why you trade way bigger, because if there's a small pullback or small drawdown in the market and it's coming down a bit, you can wipe your account or just damage it, for example. But you still get these periods, for example, from, I think this is October until the end of the year. That's like 3 months almost, and you get this nice uptrend or in the equity curve. So it happens where you get like this nice 3-4 months streak where you just make profit every single day. And for example, in these specific settings, you make on average like $70, $80, $100 per day, and but you get those massive drawdowns. All right, so that is that. I just want to show you it is possible. I'm gonna just move this thing away. This downtrend, so because this strategy is just like only buying, you can still make profit in between. So like this specific day, it took a lot, like it was like 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 16 17 trades where you made $10 on this micro. For example, it's like $170 for the day on this account, risking your whole account, and you can actually just make profit when the market's coming down. But you do get those time periods where that doesn't work. When the market is just in this uptrend, it's going to work perfectly, just buying the dips. But you get these, I want to get to something where you actually like a sideways market is working perfectly, but a trendy market, it gets risky. So you can wipe your account like this. It's like also a bit of a scare you got in terms of the market, and just exit at the end of the day. So just move back to those settings. I want to show you, if you change the end of like the stop loss, for example, some prop firms allow like $2,500 drawdown end of day or trailing, doesn't matter. In this case, I'm going to make it 2,500. So that's a 50k account usually, a prop firm. So let's change that. You will see you're going to take more losses, but maybe you average out those trades. So let's see what the equity curves pop up, and you can see you still get those nice runs in between where you just make profit. But after a year of trading, you're still flat. So risking an account, making withdrawals in your prop firm, it's possible. Withdraw $1,000, $2,000. It is possible, but then again, it's extremely risky. You can change the parameters to making. Let's change the overall profit to make it a bit more. So you want to make, let's make it $60 or $50 on a micro. So that's a bit more. Yeah, let's do that and let's see what we end up with. So it might, I'm gonna add more positions and then take your out on $50 total profit. So equity curve might look better or not. So I want to show you some scenarios. What's happening with the market. So you can still, like this period from here, minus 4,000, for example, up to 4,000. So that's an $8,000 uptrend in the equity curve. So, and it was happened in like for almost like a month and a half, 2 months. So it is possible, but like I said, be careful for dollar cost averaging. Like no new traders usually, they want to take profit. So if they see profit, they want to take it. They don't want to accept losses. So that is part of trading. Well, newer traders don't understand that. They don't want to risk any of their capital, but in the end, they're actually risking the whole account. So it also happens. So put in a stop loss, work around, trying to find an edge in the market. Yeah, and just calculate. You can see you can go and backtest anything like this. So I know some people are very successful doing it. But they do have multiple accounts, risking a lot of money. And yeah, that is it from my side, guys. See you in the next one. Cheers.